There's a date on the calendar that decides how much money stays in your pocket this year, and most Australians sleepwalk right past it. June the 30th. Miss it, and the tax office keeps thousands of dollars that should be sitting in your bank account, your super, or your future. Hit it the right way, and you can walk into July feeling lighter, richer, and finally in control. The frustrating part is that none of this is hidden. The rules are public, the deductions are legal. But every year, millions of Aussies leave money on the table because nobody sat them down and explained what to do before the clock runs out. And I get it. Tax feels boring, complicated, and like something you should leave to the accountant. But the truth is, your accountant can only work with what you bring them. If you haven't made the moves by June the 30th, there's nothing they can do in July to fix it. So let's fix that today. 5 moves you can make before June the 30th that could save you thousands, even if you've never thought about tax beyond your annual return. The first move is the one most people underestimate, and that's topping up your super with a concessional contribution. For the 2025 to 2026 financial year, the concessional cap sits at $30,000. That includes what your employer pays in, but for most working Australians, there's still meaningful room underneath that ceiling. Here's why it matters. Money you put into super from your pre-tax income is generally taxed at 15% inside the fund. Compare that to your marginal tax rate, which for a lot of middle-income earners is 30 or 32.5%, and for higher earners climbs to 37 or 45. That gap is your saving. Put $10,000 in as a personal deductible contribution, and depending on your bracket, you could cut your tax bill by $2,000 to $3,000 in one move. And if you haven't used your full cap in previous years and your super balance is under $500,000, you may be able to carry forward unused amounts from the last 5 years, stacking the deduction even higher. For someone who's taken time off work, run a small business through a lean year, or just never got around to topping up before, this rule alone can be life-changing at tax time. Just remember, the money has to land in your fund before June the 30th, and you need to lodge a notice of intent to claim with your super fund before you do your return. Leave it to the last week, and you risk the payment not clearing in time. Banks process super transfers through clearinghouses, and those clearinghouses don't work weekends or public holidays. So the safe move is to send the money by the 3rd week of June at the latest. The second move is built for anyone who works from home, even part of the week. The ATO's fixed rate method for the 2025 to 2026 year lets you claim 70 cents for every hour you worked from home. The catch is that the ATO is strict about records now. You need a diary, a timesheet, or a roster showing the actual hours you worked from home across the year. If you've been slack with this, you've still got time before June the 30th to reconstruct your hours from emails, calendar invites, and login records. For someone working from home 2 days a week, that claim alone can be worth $600 to $900 in deductions. And if you bought a desk chair, a monitor, or a laptop for work, those can be claimed separately on top, either in full if they're under $300 or depreciated over time if they cost more. The actual cost method is still available too, and for some people it gives a bigger deduction, especially if you have a dedicated home office and high power bills. It just takes more paperwork, so weigh up which approach suits your situation before lodging. The third move flies under the radar for most employees, but it can shift your refund noticeably. Prepay your deductible expenses before June the 30th. If you have income protection insurance held outside of super, the premiums are tax deductible, and you can prepay up to 12 months in advance and claim the lot this year. Same goes for professional memberships, union fees, subscriptions to industry journals, and in some cases, interest on investment loans if you're an eligible individual. The principle is simple. You're pulling next year's deduction into this year's return. If you expect your income to drop next year, maybe you're going on parental leave, taking a sabbatical, or stepping back from work. Prepaying now locks in the deduction at your higher current tax rate. That timing alone can be worth hundreds, sometimes more than $1,000, depending on the size of the prepayment and the gap between this year's tax bracket and next year's. A quick tip here. Before you prepay anything, check that the expense is genuinely deductible for your situation. Not every subscription or membership counts, and the ATO has tightened up on what it calls work-related. If you're unsure, a 5-minute call to your accountant before you transfer the money is cheaper than getting it knocked back at lodgement. The fourth move is for anyone who gives. Donations to organizations with deductible gift recipient status are claimable, but only if you donate before June the 30th and only if you keep the receipt. A $500 donation from someone on the 32.5% bracket isn't really costing $500. After the deduction, the real cost is closer to $337. You're supporting a cause you care about and reducing your tax bill at the same time. The mistake people make is donating through workplace tins, raffles, or events where you receive something in return, like a meal or a ticket. Those don't qualify. The donation has to be a genuine gift to a registered DGR with no material benefit coming back to you. Check the status on the ATO's website before you transfer the money and screenshot the receipt the moment it lands in your inbox. If you've donated small amounts across the year through different platforms, log into each one now and pull the year-to-date summary. The fifth move is about private health insurance. If you earn over $101,000 as a single or $202,000 as a family, and you don't hold private hospital cover, the ATO charges you an extra 1 to 1.5% of your income as a surcharge. On a $120,000 salary, that's up to $1,800 gone on top of your normal tax. A basic hospital policy often costs less than the surcharge itself. Take out cover before June the 30th and you can come out in front, sometimes by $1,000 or more. The surcharge is also worked out day by day, so if you only hold cover for part of the year, you still get hit for the days you weren't covered. The sooner you sort it, the more you save. And if you own an investment property, this is the window to get a depreciation schedule done. The fee is tax deductible, and a proper schedule can unlock thousands in deductions you didn't know existed. Now here's the part nobody talks about. None of these moves work if you wait. Super contributions need to clear. Insurance needs to be paid and active. Donations need to be processed. Private health policies need a start date on or before June the 30th. The financial year doesn't care about your good intentions. It only counts what's actually been done by the deadline. There's no extension, no grace period, no "I meant to" allowance. So open a notes app, write down which of these 5 applies to you and book a single afternoon to action them. That's usually all it takes to move thousands of dollars from the tax office back to your own future. And once you've done it once, you'll know exactly what to do every June from here on, which means this isn't just a one-off win. It's a yearly habit that compounds into tens of thousands of dollars across a working life. If this helped you see June the 30th differently, do me a favor and hit the like button. And if you're not subscribed yet, now's the time. And don't forget to turn on notifications so you don't miss the next one. I'll see you there.